Investors are used to seeing the stock market go up and down. It's the nature of the beast. But the last few weeks of 2024 have been a wild ride, and not in a good way. As the year comes to a close, the stock market is singing a different tune, one that's filled with uncertainty and a touch of fear. The volatility has been unprecedented, with sharp declines that have left even seasoned investors scratching their heads. Remember all those gains we saw earlier this year? Yeah, they're starting to look a little shaky right now. The market, which was once a party for bulls, is suddenly feeling a chill. Investors are wondering, is this a blip on the radar or is it the start of something bigger? The truth is, no one knows for sure what the future holds. But one thing's for certain, this December is one that investors won't soon forget. It's a stark reminder that the market can change on a dime, and that staying informed is crucial. The recent downturn has been attributed to a variety of factors. Some analysts point to geopolitical tensions that have created a ripple effect across global markets. Others believe that the market was simply due for a correction after an extended period of growth. Whatever the cause, the impact has been significant. Investors who were riding high just a few months ago are now facing tough decisions. Should they hold on and hope for a rebound or cut their losses and move to safer investments? Financial advisors are urging caution, reminding their clients that the market is inherently unpredictable. They stress the importance of a diversified portfolio to weather these kinds of storms. Meanwhile, some investors are looking for opportunities in the chaos, hoping to buy undervalued stocks at a discount. The media has been abuzz with speculation, adding to the overall sense of unease. Headlines scream about potential recessions and economic downturns, fueling the anxiety of an already jittery market. Analysts on TV offer conflicting advice, leaving many investors more confused than ever. In times like these, it's important to remember the fundamentals. The stock market has always been cyclical, with periods of growth followed by downturns. While the current situation may feel dire, history has shown that the market eventually recovers. So, as we close out this tumultuous year, investors would do well to stay informed, stay calm, and stay the course. The market's end-of-year slump is a stark reminder of its inherent volatility, but also of its resilience. Here's to hoping for a more stable and prosperous year ahead. Let's talk numbers, folks. When the market takes a hit, it's not just a few stocks feeling the pain, it's a widespread sell-off, and that's exactly what we're seeing right now. The major stock market indices, those barometers of the market's health, are flashing red. The S&P 500, home to some of the biggest companies in America, is down. The Nasdaq, known for its tech giants, is down even more. And the Dow Jones Industrial Average, with its blue-chip companies, is feeling the heat too. This isn't a sector-specific slump, it's a broad market decline. What does this tell us? It tells us that investors are losing confidence, and when confidence goes, so does the market. It's a classic case of fear and uncertainty driving the selling. Hold on to your hats, because this next part is a real head-scratcher. Treasury yields, those bellwethers of the bond market, are doing something unexpected. They're retreating. You'd think that would be good news for stocks, right? Not so fast. Typically, when Treasury yields go down, it means investors are looking for safer havens for their money. And when they're not pouring money into bonds, they're more likely to put it into stocks. But here's the thing. This time the stock market isn't getting the usual boost from falling yields. It's like the market is stuck in a rut, unable to find its footing. The usual rules don't seem to apply, and that's making investors nervous. It's a sign that there are deeper forces at play, forces that are keeping a lid on market sentiment. Big tech stumbles. Tesla and Nvidia drag down market sentiment. Tech giants like Tesla and Nvidia have been market darlings for years, their meteoric rise a testament to the power of innovation. But lately, even these titans of industry are showing signs of weakness, and that's bad news for the entire market. When big tech sneezes, the rest of the market catches a cold. Tesla, the electric vehicle pioneer, has seen its stock price take a hit, raising concerns about demand and competition. Nvidia, a leader in the world of graphics processing units, or GPUs, is also facing headwinds as the chip market shows signs of slowing down. These aren't just isolated incidents, they're indicative of a broader trend. The tech sector, which has been a major driver of market growth, is losing steam. And when tech falters, the entire market feels the tremors. Santa's missing rally, a break from tradition fuels uncertainty. This year the holiday season has brought with it an unexpected twist, leaving many investors scratching their heads and wondering what went wrong. Remember that warm, fuzzy feeling you get around the holidays? The one that makes you want to spread cheer, buy presents, and enjoy the festive spirit with your loved ones? It's a time when everything seems a bit brighter, and the world feels a little more hopeful. The one that makes you want to spread cheer and buy presents? This sentiment often extends beyond just personal celebrations and into the financial markets, where investors typically feel more optimistic and willing to take risks. Well, the stock market seems to have missed the memo this year. Instead of the usual year-end cheer, we've been greeted with a sense of unease and uncertainty. The numbers on the ticker tell a story of decline rather than growth. The Santa Claus rally, that time-honored tradition of year-end market gains, is nowhere to be found. This phenomenon, which usually brings a sense of relief and joy to investors, has been conspicuously absent. Historically, the stock market tends to rally in the last few days of December and the first few days of January. This period is often marked by a surge in stock prices, driven by a combination of factors that create a perfect storm for market gains. It's a phenomenon that's been attributed to everything from holiday optimism to year-end bonuses. Companies often distribute bonuses at this time, and employees, feeling flush with extra cash, may invest in the market, driving prices up. But this year, Santa seems to have left investors with a lump of coal in their stockings. Instead of the expected rally, we've seen a downturn, leaving many to wonder what has changed. The absence of a Santa Claus rally is more than just a statistical anomaly. It suggests that the usual drivers of market sentiment are being overshadowed by larger, more complex issues. Economic uncertainties, geopolitical tensions, and other global factors are playing a significant role. It's a sign that the usual seasonal factors that drive market sentiment are being overshadowed by something else. Investors are cautious, and this caution is reflected in the market's performance. The traditional end-of-year optimism has been replaced by a more sober, realistic outlook. It's a reminder that the market doesn't always follow the script, and that surprises, both good and bad, are always possible. As we move into the new year, investors will need to stay vigilant and adaptable, ready to navigate whatever challenges and opportunities come their way. The absence of the Santa Claus rally serves as a poignant reminder that in the world of finance, nothing is ever guaranteed. 2024 in review, a year of growth overshadowed by a late decline. This year has been a roller coaster for investors and market watchers alike. From the highs of early gains to the lows of a late-year decline, the market has kept everyone on their toes. It's easy to get caught up in the day-to-day fluctuations of the market, especially when headlines scream about record highs one day and significant drops the next. The constant barrage of information can make it difficult to maintain perspective, to let the headlines dictate our emotions. The media often amplifies the drama, making every rise and fall seem more significant than it might be in the grand scheme of things. This can lead to emotional decision-making, which is rarely beneficial in the world of investing. But it's important to remember that investing is a long game, one that requires patience and a steady hand. The most successful investors are those who can look beyond the immediate noise and focus on long-term goals. They understand that the market will have its ups and downs, but over time it tends to trend upward, and that short-term volatility is par for the course. This year has been a perfect example of that. While the late-year decline has been concerning, it's also a reminder of the inherent risks and rewards of investing. The key is to stay the course and not let short-term movements derail long-term plans. So, as we bid farewell to 2024, let's take a moment to reflect on the journey we've been on. The market's performance this year has been a testament to its unpredictable nature, but also to its resilience. Despite the late-year downturn, there have been many positive moments worth celebrating. Let's take a step back and look at the bigger picture. Over the course of the year, we've seen significant growth in various sectors from technology to healthcare. These gains have been driven by innovation, consumer demand, and a generally strong economic environment. Yes, the market is ending the year on a sour note. The recent downturn has been a stark reminder of the market's volatility. However, it's also important to recognize that this is a natural part of the market cycle. What goes up must come down, and vice versa. But let's not forget that for most of the year, it was a different story. The market experienced several months of robust growth, with many investors seeing significant returns on their investments. These periods of growth are just as important to remember as the downturns. The S&P 500, the Nasdaq, and the Dow Jones Industrial Average all posted significant gains, reflecting the overall health and resilience of the U.S. economy. These indices are often seen as barometers of economic performance, and their gains this year have been encouraging. And the Dow Jones Industrial Average all posted significant gains, a testament to the resilience of the U.S. economy. This resilience has been driven by strong corporate earnings, consumer spending, and a generally favorable economic environment, a testament to the resilience of the U.S. economy. The recent downturn is a reminder that what goes up must eventually come down. However, it's also a reminder of the opportunities that can arise during these periods of decline. The recent downturn is a reminder that what goes up must eventually come down. It's a natural part of the market cycle. These cycles are driven by a variety of factors, including economic data, corporate earnings, and investor sentiment. It's a natural part of the market cycle. Understanding these cycles can help investors make more informed decisions and avoid the pitfalls of emotional investing. By recognizing the patterns and trends, investors can better navigate the ups and downs of the market. But it's not necessarily a cause for panic. In fact, it could be a buying opportunity for savvy investors. Those who can keep a cool head and look for value in the midst of a downturn often find themselves well positioned for future gains. In fact, it could be a buying opportunity for savvy investors. As we move into the new year, it's important to stay focused on long-term goals and not be swayed by short-term volatility. The market will continue to have its ups and downs, but with a steady hand and a clear strategy, investors can navigate these challenges and find success. Looking ahead to 2025, key factors to watch for investors. As we turn the page on 2024 and look ahead to 2025, one thing is clear: uncertainty reigns supreme. The market is at a crossroads, and the path it takes from here will depend on a multitude of factors. Investors will be closely watching economic data, corporate earnings, and geopolitical developments for clues about the future. Inflation, interest rates, and the direction of the global economy will all play a role in shaping market sentiment. The bottom line is this: buckle up, because 2025 is shaping up to be another wild ride. The market is unpredictable, and that's what makes it both exciting and terrifying. But by staying informed, staying disciplined, and staying focused on the long term, investors can navigate the volatility and come out ahead.